For decades, Americans believed that as long as they had a job and an income, they could at least afford to keep their car. That belief is shaking. Not because of the sudden surge in gas prices. Not because of a shortage of cars on the market. But because millions of American households are stuck in car loans that last 72, 84, or even 96 months, with interest rates higher than their actual incomes can handle. If you're a working person who drives to work every day, if you live in a suburb without public transportation, if your car is more than just a means of transportation but a necessity for survival, then this story is not far removed from reality. In this video, we'll go through 3 key indicators. The rise of subprime auto loans. A silent wave of vehicle recalls spreading across the U.S. And a burgeoning risk, the possibility that this shock won't stop at borrowers, but could spill over into the consumer finance system. Data from regional central banks shows that the rate of seriously delinquent auto loans has approached levels previously only seen during previous crises. At the same time, rating agencies and organizations tracking the consumer securitization market are reporting increased losses in the subprime auto loan segment. These numbers, taken individually, might not cause panic. But when placed together, against the backdrop of real incomes being eroded by persistently high living costs, they pose a much bigger question. What happens when the car, a symbol of freedom, of the ability to commute and sustain life, becomes a debt that people can no longer afford? And what happens next if the recall of millions of vehicles is not just a personal tragedy, but a signal of a systemic breakdown? In the official picture of the U.S. economy heading into 2026, the labor market is still described as stable, unemployment remains at historically low levels, and household consumption has not collapsed. Economic news reports often emphasize that Americans are still spending, retail sales haven't plummeted, and the financial system hasn't experienced the kind of shock seen in 2008. But U.S. economic history shows that consumer crises rarely begin with a simultaneous collapse. They often start in less noticed areas, in seemingly small asset classes, and in debt considered secondary to housing or the stock market. Auto loans are one such area. Since the 2008 global financial crisis, the U.S. credit market has undergone a prolonged period of expansion. As low interest rates became the new normal for over a decade, consumer loans, from credit cards and student loans to auto loans, expanded dramatically. For cars specifically, the loan structure fundamentally changed. Instead of focusing on the total value of the car, the market began to revolve around another number, the monthly payment. Loan terms gradually extended from 48 months to 60, then 72, and 84 months. This stretching made the car seem more affordable, even as car prices and real interest rates increased. During the 2020 to 2022 period, stimulus packages and income support programs masked many of the underlying risks. Borrowers were able to repay their debts, even when incomes didn't increase proportionally to their financial obligations. But as inflation escalated, interest rates rose sharply, and support programs ended, the negative aspects of the long-term loan structure began to show. By 2024 to 2025, the first signs became clearer. The rate of default on subprime auto loans increased faster than other types of debt. The number of repossessed vehicles rose again, not only in low-income areas but also among the middle-class working class in suburban areas. Mainstream media still tended to portray this as a localized problem. The common argument was that a strong labor market would help people cope, and auto debt wasn't large enough to threaten the entire system. Compared to the housing market, the scale of auto debt was smaller. Compared to the stock market, the level of leverage seemed lower. But history shows that absolute size isn't always the deciding factor. More important is the contagion of the shock. With cars, the shock isn't just about the asset value, but about its social function. Losing a car is not the same as losing a financial investment. Losing your car means losing your ability to work, losing income, and quickly falling into a more unfavorable financial spiral. That's the structural difference compared to many other types of debt. As macroeconomic indicators continue to signal stability, while microfinance begins to fracture, the auto loan market becomes the clearest example of this mismatch. It doesn't create immediate crashes, but accumulates pressure over time, like an underground current silently rising beneath the surface of the American economy. The question isn't whether the auto market will collapse. It's, when the financial pressures on Americans build up long enough, where will the first breaking point appear, and why is it appearing in the very car they depend on every day? On the surface, many Americans still have jobs. Nominal incomes continue to rise. These figures are enough to give the impression that the economy is functioning normally. But in real life, the financial pressures on households have fundamentally changed. The direct cause lies in the shrinking of real incomes. For years in a row, the cost of living has outpaced wages. Rent, health insurance, auto insurance, food, and essential services are all pegged at high levels. With the majority of income locked into uncut expenses, people's financial flexibility has virtually disappeared. In this context, auto loans are no longer a manageable obligation. They have become a constant source of stress. Auto loan interest rates have surged after periods of monetary tightening, but signed contracts cannot be adjusted. Borrowers are trapped in fixed payment structures, while other costs continue to escalate. Another direct cause is the prolonged negative equity. When loan terms are extended to 72 or 84 months, the rate of depreciation of the vehicle outpaces the rate of repayment. In the first few years, the market value of the vehicle is lower than the amount owed. This makes it difficult for borrowers to exit the contract. Selling the car doesn't cover the debt. Trading in a new car means rolling the old debt into a new contract, further inflating the financial obligation. At a deeper level, the indirect, systemic causes are the decisive factor. The U.S. consumer credit market over the past decade has been designed to maximize accessibility, not long-term resilience. Lending standards were loosened based on the assumption that consumers would always have jobs, and income growth would keep pace with debt obligations. This assumption began to skew as the labor market became fragmented. Many new jobs were temporary, part-time, or lacked income stability. Workers have jobs, but lack the security to absorb minor financial shocks. A single unexpected medical bill, a week of reduced hours, or unexpected car repair costs can immediately threaten their ability to repay debts. The survival behavior of households clearly reflects this. Instead of cutting flexible expenses like entertainment or travel first, many are forced to postpone or ignore financial obligations. Missing one payment becomes the starting point of a chain reaction: penalties, interest charges, a drop in credit score, and increased borrowing costs on other contracts. In this context, the media's continued assertion of a stable economy creates a psychological paradox. People see positive macroeconomic indicators, but their personal experience is increasingly precarious. This gap between the two realities erodes trust in official messages while simultaneously downplaying micro-level crisis signs until they become unmissable. The auto loan market, therefore, reflects not only people's financial difficulties. It is a convergence of weakening real incomes, escalating fixed costs, and a credit structure built on assumptions that are no longer relevant to the current realities of American society. To understand why the auto loan market has become a hotbed of risk, one needs to look beyond the individual behavior of borrowers. The core issue lies in how the U.S. economic and financial system has been restructured over the years, particularly under the influence of monetary policy, consumer finance, and shifts in the labor market. First, there is the role of monetary policy. The prolonged period of low interest rates following the 2008 crisis created an environment where credit became a tool to offset stagnant incomes. When wage growth failed to keep pace with the cost of living, borrowing was seen as a reasonable solution to maintain a standard of living. The auto loan market directly benefited from this logic. Lenders extended loan terms, reduced down payments, and accepted higher risks to sustain growth. When the tightening monetary cycle began, that structure didn't disappear. It just became more fragile. Rising interest rates make new borrowing more expensive, but millions of existing contracts remain with fixed obligations, while other costs continue to escalate. Borrowers don't benefit from faster income growth, but instead bear the full impact of a harsher financial environment. The second factor is the financialization of the auto loan market. For years, these loans didn't just exist on banks' balance sheets. They were pooled, securitized, and sold on the financial market as consumer debt products. This process helped to spread risk on paper, but at the same time blurred the link between the original lender and the end borrower. As risk is transferred, the system's motivation also changes. The focus is no longer on the borrower's ability to sustainably repay the loan throughout the contract's life, but on the ability to create a sufficiently large product line to serve the needs of the financial market. This explains why subprime loans continue to expand, even as delinquency rates begin to deteriorate. The third development relates to the structure of the labor market. The U.S. economy is increasingly reliant on flexible employment, short-term contracts, and low-margin service jobs. This model creates the appearance of a dynamic labor market, but lacks the capacity to absorb risk at the household level. Workers may earn enough money during favorable months, but lack a financial buffer when conditions worsen. In this context, the car plays a central role. It's not just an asset, but a tool for accessing employment. When car loan obligations become too heavy, the risk doesn't stop at losing the vehicle. It spills over into the ability to maintain income, and quickly impacts other debts such as credit cards or rent. Finally, there's the issue of wealth inequality. High-income groups can afford to buy cars with cash or short-term loans at preferential interest rates. low and middle income groups must rely on longer terms and higher interest rates. The same car, but with completely different financing structures. The system, in this way, distributes risk unevenly. The benefits of credit growth are widely shared, while the costs of decline are concentrated on the most vulnerable groups. When these factors combine, the auto loan market becomes a breeding ground for pressure. A major shock isn't needed to trigger a crisis. Simply the prolonged high interest rates, eroded real income, and declining confidence will cause the system to break down. It's noteworthy that this process is slow and diffuse. There's no specific day of collapse. Only the number of repossessed vehicles gradually increases, overdue payments spread, and risk signals appear more and more frequently in financial reports. That's how a modern consumer crisis develops. The first and most direct consequence of the wave of auto loan defaults falls on the American people themselves. When a payment is overdue, the chain reaction begins almost immediately. Penalties are incurred, credit scores decline, and borrowing costs for other obligations increase. For many households, it's a moment when personal finances shift from strain to complete breakdown. When a vehicle is repossessed, the impact is no longer purely financial. Workers lose their means of transportation, which means the risk of lost income. In many suburban and rural areas, where public transportation is virtually non-existent, losing a vehicle means losing access to the labor market. This creates a vicious cycle. Losing a vehicle leads to losing a job. Losing a job leads to deeper default, and the prospect of returning to financial stability becomes increasingly distant. For the middle class, the consequences take a different but equally serious form. Households once considered stable began to restructure their spending. Non-essential consumption was cut back, major purchases were postponed, and willingness to borrow for the future declined significantly. As millions of households simultaneously tightened their spending, the macroeconomic impact began to emerge. Small businesses were the next group affected. Many local shops and services depend directly on the spending of the working and middle classes. As demand decreased, revenue narrowed, weakening the ability of small businesses to retain employees and invest. This created a ripple effect back into the labor market, increasing income uncertainty, a factor that contributed to triggering the auto loan crisis in the first place. On a broader level, local communities faced increasing pressure. Auto foreclosure is not just a matter between borrowers and credit institutions. It entails administrative, legal, and social costs. Areas with high repossession rates often experience a decline in property values, increased social unrest, and pressure on public services. These impacts are not easily measured by traditional economic statistics, but they directly affect the quality of life. Even financial institutions are not immune to this. As the number of repossessed vehicles increases, the actual repossession value often falls short of expectations, especially in a context where the used car market is under significant supply pressure. This worsens the performance of consumer debt portfolios and forces institutions to be more cautious in granting new loans. Consequently, credit is tightened precisely when people need it most, exacerbating the downward spiral. The middle class, considered the backbone of American consumption, is in a particularly vulnerable position. They are not wealthy enough to avoid borrowing, but also not poor enough to access targeted support programs. When car loan obligations become unsustainable, the financial security that this class once believed in begins to crumble. The car loan crisis, therefore, is not an isolated incident. It is a chain of overlapping effects, spreading from individuals to communities, from consumption to labor, and from the credit market to the real economy. Each repossessed vehicle is a sign that financial pressure has exceeded a household's tolerance level. When these signs appear with increasing frequency, they become indicators of a much larger problem. When discussing car loan defaults, much attention is focused on the numbers, delinquency rates, repossession rates, or losses across consumer debt portfolios. But behind those statistics lies a less discussed layer of risk, and it is this layer that determines the sustainability of the real economy. The group most severely affected often doesn't appear clearly in aggregated data. These are low and middle-income workers living in areas almost entirely dependent on personal transportation. For them, a car is not just an asset, it's a means to access employment, healthcare, and essential services. Losing a car isn't measured by the value of the repossessed asset, but by the loss of their ability to fully participate in socio-economic life. Another often downplayed risk is the long-term impact on credit scores and access to finance. Delayed payments or repossession leave lasting marks for years. This not only impacts large future loans, but also increases insurance costs, rental deposits, and even job opportunities in some sectors. The consequence is a locked-in financial disadvantage that is difficult to reverse in the short term. The used car market is another important piece of the puzzle that is often overlooked. As the number of repossessed vehicles increases, the supply of used cars in auctions and retail markets also increases. In the short term, this can put downward pressure on prices. But for borrowers with negative equity, falling used car prices worsen their chances of recovering the asset's value, resulting in greater financial losses for both borrowers and lenders. This is a negative feedback loop, where each attempt to manage risk inadvertently creates new pressure. Less often mentioned is the distribution of risk within the financial system. When auto loans are securitized, losses don't disappear, they are simply dispersed. Investors, pension funds, and other financial institutions holding these products may not face an immediate shock, but the sustained decline in consumer debt performance erodes confidence in predictability and risk pricing. This is a form of cumulative risk, difficult to detect until it becomes large enough to impact market behavior. Another often overlooked factor is the social cost of vehicle repossession. Each repossession entails administrative, legal, and enforcement activities, putting pressure on local justice systems and social services. These costs do not appear in the earnings reports of credit institutions, but are borne by the community in various forms. Finally, the auto loan crisis exposed a structural weakness: the U.S. economy's reliance on credit to maintain living standards. When credit stops expanding, or becomes more expensive and risky, the borrowing-based consumption model begins to run its course. These limitations don't appear all at once, but gradually emerge in the most vulnerable groups before spreading. These overlooked issues don't generate sensational headlines. They accumulate silently, but it is precisely the silence that makes the risks more dangerous. When the system only reacts to late signals, the ability for early intervention and soft adjustments is significantly reduced. The mortgage crisis wasn't just a balance sheet story. It was a widespread psychological shock, altering how Americans viewed their own financial future. As debt pressures persisted and options became increasingly limited, confidence, an intangible but crucial element of a market economy, began to erode. The first sign was a delay in spending. Even households that hadn't fallen behind on payments became more cautious. Major purchases were postponed. Expenses once considered normal now required careful consideration. This caution didn't stem from a single shock, but from a feeling that the personal financial system had lost its safety buffer. Confidence in personal resilience also eroded. In the past, many Americans believed that financial hardship was only temporary. Working harder, taking extra hours, or changing jobs were seen as ways out of debt pressure. But when the car, a tool for maintaining income, becomes a source of risk, this logic reverses. People begin to doubt their own ability to self-regulate in an increasingly harsh system. This skepticism quickly spread to how official economic messages are perceived. As the media continues to emphasize growth and stability, while personal experience is rising costs and persistent debt pressures, the perception gap widens. That gap undermines the effectiveness of policy signals and makes consumers more responsive to reassuring messages. A defensive mindset gradually becomes prevalent. Consumers prioritize holding cash, reduce their use of new credit, and seek to mitigate personal risk. At the macro level, this behavior means a slowdown in the velocity of money in the economy. Consumption, the main driver of U.S. growth, loses momentum not because of a major shock, but because of the accumulation of anxiety. Notably, this shift is long-term. Once confidence is damaged, it's not easily restored by positive economic indicators alone. People need time to believe that their incomes are stable enough, that their financial obligations are manageable, and that the system isn't continuing to shift risk onto them. During that waiting period, cautious behavior becomes the new norm. This psychological crisis also shifts expectations about the future. Instead of planning for expansion, buying a bigger house, upgrading to a new car, investing in education, many households are shifting to a defensive strategy. They focus on maintaining the status quo, avoiding risk rather than seeking opportunities. This shift in expectations, if prolonged, could diminish the long-term growth potential of the economy. The car loan crisis, therefore, creates more than just financial losses. It shakes a more crucial pillar, the belief that individual effort within a fair system will lead to stability and progress. As that belief erodes, the economy enters a more fragile state, where even a small additional shock can trigger a more powerful reaction than expected. The auto loan crisis in the United States didn't emerge as a sudden event. It developed gradually, over years of accumulating policy choices, market structures, and economic assumptions that no longer reflected people's real lives. When the car, a means of transportation linked to commuting and income maintenance, becomes a financial breaking point, the issue is no longer personal. What's happening isn't the failure of individual borrowers. It reflects the limitations of a growth model heavily reliant on consumer credit to offset stagnant real income. In that model, the risk is shifted to the individual, and the system only reacts when financial indicators begin to deteriorate. The wave of defaults and repossessions highlights a thought-provoking reality. Access to credit doesn't equate to the ability to withstand long-term financial obligations. When loan terms are extended, and interest rates and the cost of living both escalate, consumers' safety margins narrow to the point where even a small fluctuation can trigger a breakdown. Currently, macroeconomic indicators may not yet signal a full-blown crisis, but microeconomic signs are appearing with increasing frequency. Economic history shows that such signals rarely exist in a vacuum. They are usually the first part of a larger adjustment chain, impacting consumption, labor, and confidence. The key question isn't whether the auto loan market will collapse. The question is how the system will react when more and more people are no longer able to maintain the basic financial obligations they depend on to live and work. Will the adjustments be orderly, or will they only appear after pressure has exceeded societal tolerance? This crisis also raises a broader question for the U.S. economy: the sustainability of consumer-driven growth in the face of persistent income inequality and high living costs. If the car, a symbol of personal freedom, no longer guarantees mobility and financial stability, then faith in the fundamental promise of the economic system will continue to be tested. There are no absolute conclusions to this story. Only uncertainty, and future policy choices will determine whether the current pressures are gradually eased or continue to build into a larger shock. What is certain is that what is happening in the auto loan market is no longer a minor incident. It is a test of the adaptability of the entire U.S. consumer economic model in the post-low interest rate era.